Welcome to Morningstar. I'm Holly Black. With me is Alistair Wittet. He's manager of the Comgest Growth Europe Fund. Hello.
Good afternoon.
So I guess the clue's in the name. You're looking at Europe at the moment, and that was one of the first places outside of Asia to be affected by the coronavirus pandemic. What's the impact been on the fund over the past few months?
So the fund has proved to be incredibly defensive. Actually, remarkably, given what's happened, the fund is up year to date. And that's largely because of two factors. On the one hand, the market itself has recovered a lot over the past couple of months. And we can maybe come back to the reasons behind that. But there's definitely been, over the last, let's say, 2.5 months, a big rebound and an increase in optimism about the outlook for Europe. And on the other hand, the sorts of companies that we invest in tend to be the companies that are least impacted by the likes of COVID-19 because they are, in many cases, providing very essential services like healthcare or food or supermarkets, or because where they are heavily impacted, they have very substantial safety mechanisms, whether that be a strong cash pile, whether it be a very reactive management force, etc. So on the whole, our companies have fared better than the markets, and that's led to quite a substantial outperformance since the start of the year. And as I said, the fund is up so far.
And yeah, you say we are now seeing stock markets start to recover. Is that going to continue, or do you think there is a risk to performance if there is a second wave?
I think there's been a lot of optimism as markets have, on the one hand, as countries started talking about opening, and then on the other, once they've opened and when we started to see the data come through. And there's a very interesting data point this morning. Inditex, the largest clothing retailer in the world, they own Zara, Massimo Dutti, those sorts of brands. They mentioned that in markets like China, Korea, Japan, their sales are back to very close to levels seen last year. We've also had updates from the likes of Primark in the UK, in Europe, which is a store-based only retailer. So it's a very interesting gauge for what's happening on the high street. And they've also talked about sales in many of their stores above that of last year. So there's been quite a few data points that have pointed to the reopening being met with quite a lot of enthusiasm by consumers, and they've come back out and spent. I think the big question is whether this is sustainable. And the OECD came out this morning with quite a dire outlook for the economy under two scenarios, one where there's a second lockdown and the other where there isn't. And in both cases, you're looking at 2021 GDP substantially below 2019. So I think there's a lot of optimism in the market today, but I think there's a lot of reason to still be somewhat cautious.
And have you made any changes to your portfolio this year in light of what's happening?
So at the margin, a context which is quite specific to our portfolio and to our investment style is that the last 2 to 3 years have seen valuations for quality growth stocks go up quite substantially. And that has led us, for valuation reasons, to reduce our exposure to those names and to own, let's say, some slightly less dynamic growth companies, but with much more reasonable valuations. What we were able to do in the sell-off in February and in March was start to reorientate the portfolio back towards those faster growth names. More recently, we haven't been doing a lot because valuations have come back up again, and that window for opportunity closed relatively quickly.
But that is it. So your remit is growth. So I'm quite surprised to hear you talking about defensive names in the portfolio and supermarkets and healthcare. Stocks you're typically drawn to?
Yes, because you can find defensive growth. There's quite a lot of sectors of the economy where you do get very strong defensive qualities and very strong growth. And healthcare is an excellent example of it, where healthcare spending globally has been growing for a very long time. I think in the US, there's not been a down year since 1960. So it's an extremely defensive sector. It's also a growing sector, and the best companies within those sectors can leverage that growth with unique products, with unique R&D, with unique routes to market, and deliver very strong growth. Even some of the largest healthcare names that you would have thought are kind of ex-growth companies like Roche in the pharmaceutical sector is delivering high single-digit growth. So that there's still growth in these sectors.
Alistair, thank you so much for your time. For Morningstar, I'm Holly Black.